Welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with Mike Loukas, who's the CEO of TrueMark Investments. Great to have you on the show.
Pleasure to be here. Thanks for having me.
Absolutely. So, buffer ETFs, Mike, had a phenomenal year in 2024. But as you're well aware, there's a wide disparity between all of the buffer ETFs that are available. What should advisors and investors understand about this space as it continues to grow?
Well, that's a very good point. I mean, there's a bit of a ticker soup out there now, if we can call it that, right? We've got buffered ETFs any way you can slice and dice it. I think what's important to understand about the entire segment is that it's really just math, right? So understanding what the expectations are of your portfolio construction or your investor and applying what buffered ETF or defined outcome ETF makes sense for those expectations is really the key here. Most, if not all of them, will do what they're supposed to do if they're held to the duration of the investment period. It's just important to understand what the expectation is. So, there's some stylistic differences, but it all comes down to math. I mean, these are math-based products, and they should perform the way they're expected to. Just match up expectations with risk tolerance and portfolio construction, and it should be okay.
So, Mike, you're with TrueShares, and you guys have a lineup of buffered ETFs, and a couple of them caught my eye. You have something called monthly uncapped buffer ETFs. Can you tell us how these work?
Yeah, so we were the first ones in the uncapped ETF buffered space, and we launched our first one back in July of 2020. So we have a monthly series. Each one of the months is over 4 years old now. And the difference between most of our peers, which are capped products, really lies in the upside participation. So we believe that exposure to large cap US equities is a growth play. And you don't want to corrupt or eliminate the growth characteristics of that asset class. Otherwise, what's the point, right? So the idea of mitigating the downside, yeah, that's great. We're all on board with that. But trying to harness both sides of that volatility spectrum, meaning let's mitigate or buffer the downside, but let's capture as much of that right tail volatility, the good, quote unquote, good volatility that we can capture. Because when it comes to your long-term compounded returns, that is it's paramount that you capture as much of those lumpy up years as you can. So when TrueShares designed the structured outcome product, we decided to go with the uncapped structure, which gives you unlimited upside to a participation rate rather than one-to-one to a cap. Meaning, historically speaking, you could get somewhere between 75% to low 80s upside capture on large cap US equities over a 12-month period. And yes, there are sort of three outcomes when you compare that to the capped peers that we have out there. The first outcome is, say, the market's down 10%, we all tie, we all buffer it out. Market's up 10%, we're going to lose by a little bit. We may be up 8%. But when you have a banger of a year like we did in 2020, 2021, or last year even, capturing of as much of that lumpy upside, and when you have a product that could give you, I think in the first year we had it out there, the market was up 38 or 39%, we returned 31. So the idea of those lumpy up years, the non-sequential returns, and capturing that good volatility when it's there and taking advantage of that in your long-term compound returns. That's at the core of what we do at the TrueShare structured outcome level. So it is inherently a little bit of a bullish product, right? We want to maintain the core characteristics of equity exposure while providing that downside buffer and therefore dealing with both sides of the volatility spectrum.
Yeah, really interesting stuff. So, Mike, we just talked about those monthly products that you have. You also have these quarterly products. I think the ticker symbols are QBUL and QBER. Can you tell us a little bit about these?
Yeah, so Q Bull and Q Bear, as we call them in-house, they're quarterly products and they are principal protected products. So what that means is your risk in either ETF is that of treasury risk. But we take the income from the treasury and we apply an options overlay to the portfolio. And so, as you might expect with Q Bull and Q Bear, they're directional market exposure. One is bull, meaning you're going to have upside market participation to a certain level with treasury risk to the downside. And bear, you're going to have a positive return from a significant downward move, again, with substantial principal protection because your principal is in a treasury. So really what they amount to be is it delivers directional market participation. It gives you principal protection. It gives you tighter correlation to market moves. As we already talked about the 12 months or the 6-month buffered ETFs, because of the options underlying mechanism and how price decay works, it takes some time for that market correlation to narrow out towards the end of the investment period. With the quarterly product, you've got that principal protection and you've got much tighter correlation to market moves intra-quarter. Now, the one rub here is that the market move needs to be greater than 5% on average, right? So if the Q bull, the market moves greater than 5% a quarter, then your Q bull will kick in and you'll gain some convexity north of 5%. So the higher the market moves, the tighter that gap between Q bull performance and the actual market performance becomes. Conversely, with Q bear, any market move south of 5%, meaning the market goes down in excess of 5%, then it starts to generate a positive return. And same concept as Q bull, that convexity will give you a greater positive return and gain closer to the market as the deeper it goes. So it's really, again, those four keys: principal protection. It compares well to the 100% buffer products in the space. And it gives you a shorter time frame and therefore a tighter correlation to market moves and extreme versatility, right? So these products can be used to blend in with a buffered product. If you have a capped buffered product, even Q bull can uncap the capped product, right? Q bear can create positive downside, movement for a buffered product that's in the buffer. So if you have a buffered product that's buffering out your downside, you can actually have an allocation to Q bear that's going to create a positive return when your buffered product is giving you a zero return. So the blend works really well there, and certainly there's a usable in any type of portfolio. If you have long only equity, if you're tactical and you go to cash, but you just you want to hedge against being wrong, you own Q bull. If you're long only and you want to hedge against being wrong, you might want to own Q bear. So it really comes down to principal protection, shorter time frames, greater versatility, and it really is a portfolio construction solution as much as anything else.
So, Mike, you have all of these really interesting products, and like you said, you can kind of mix and match them, blend them together based on your goals. But how active do advisors, investors need to be when they're using these products? Are they buy and hold and just forget about them, or do you have to be a little more active with them?
Yeah, I think it's a stylistic choice to the advisor, right? I mean, they work both ways. And I know advisors that allocate to these products that are quite good at managing them on a daily basis and strategically or tactically harnessing gains or moving in and out of expected return scenarios. And a lot of allocators just set it and forget it. So it really is, again, a bit of a stylistic choice. And they work either way. As a core investor, we believe that you should be in these products in unison with whatever your long-term outlook for large cap equities is, right? So to the extent you nibble around the edges or get tactical with it, we leave that to the advisor. I think Q bull and Q bear probably lend themselves to being a bit more tactical for the advisor in terms of how they use them, because outlooks on markets can change near term or long term, and you can toggle back and forth and adjust to that. But by and large, it can work both ways. And I'll do an unsolicited, pump up of our single ticker solution that's listing here in about a week, a little under a week, called OneZ, ONEZ, and that will encompass all 12 of our structured outcome ETFs and Q bull and Q bear, and will be managed on a ladder basis with some active management and toggling back and forth for seasonality and for short-term market moves. So again, the idea is to provide these solutions to investors and model providers and portfolio construction managers and allow them to use them as they see fit within their portfolio tolerances and risk matrices.
Well, awesome. We're going to have to leave it there. Mike, you gave us a ton of great insight. Thanks so much for your time.
Yeah, great. Thank you. Always a pleasure.